guys, how's it going? I hope you guys enjoyed your weekend. I've not been feeling too great over the weekend myself. I did end up eventually getting ill. Sat down to record this last night, but I had a mad headache, so I went to bed early. So kids have been off school Monday, and I haven't had the chance to sit down and actually record these until Monday evening. So I've had to readjust some of the slides based on what's actually happened and transpired over the course of Monday's trading. Firstly, we're in a period of where daylight saving hours are coming into effect, and we've also got the general elections coming out, so on Tuesday for the US. So there's probably going to be some sort of volatility in the markets, and personally, I'm not going to really be doing too much this coming week. Last week, again, we had a lot of high impact news, and I didn't trade last week either. As you all know, there's a lot of tension going on around the world, and I keep saying, you need to respect the risk, and I think any good mentor would tell you that right now. Don't be going out and just taking silly trades. I haven't been, like ICT, I haven't been in the forex markets myself. I'm mainly sticking to the S&P 500 at the moment and really staying in the index market. I'm going to try to quickly go through the analysis and a few teaching points today. So hopefully this won't be too long of a video. So this was last week's trading when I took the screenshot from Sunday. And as you can see what transpired, I said that if we ended up running through this fair value gap, we may find support, which we did looking at the bodies of the candles, and we were wicking through this, so we wanted to stay above this fair value gap, dipping back into this order block. Again, rallied through the discount end of this fair value gap, and then found support, and then found resistance at the premium end of this fair value gap. Then on Friday, we absolutely just tanked, closing below this fair value gap. So we've dipped inside of this order block, and this has become a balanced price range for me. So from this candle's low to this candle's high, we've gone down, we've repriced, we've wicked through, and then rebalanced. So in hindsight, my intention was to say that I expect price on Monday to probably trade higher into this balanced price range, and then we're expecting probably lower prices to take out this low. And I wanted to keep an eye on this mean threshold. Of course, I didn't end up recording, and this is what ended up happening. So we ran higher into the balanced price range, and then found resistance and sold off. Now, we did close below the mean threshold from, well, when I've took this screenshot of this down close candle. We ran liquidity here. Closing below that, the next area would have been this rejection block, so this last down close candle. And I think from where we currently are, we're actually below the rejection block. If that's the case and we close below it at the end of the day, then the sell side liquidity underneath these relative equal lows and possibly down here. This dotted line is a bullish breaker. So that would be like my initial first target, to sweep the sell side liquidity down here, and then dip in maybe to this volume imbalance, because again, between the bodies of these two candles, this is really thin price action. So there's not any volume there. We did run through it, but only offered buy side delivery. So we may want to run sell side liquidity below these lows and dip further down into this volume imbalance to maybe leave a body in there and rebalance some sell side delivery. So are we going to keep going lower? Time will tell. I'm still not 100% convinced that we've seen a turning point, but if we get below here and get below the volume imbalance, then yeah, it's possible that this could be a more longer term high for the dollar index, which would create a risk on scenario for the rest of the assets really. So we have to bear in mind, with the general elections coming over, there's going to be a lot of manipulation in the market. So we really want to tread with caution over the next coming weeks. Euro dollar, again, I took the screenshot from Sunday. We had come into this balanced price range. We found support around the consequent encroachment area of the fair value gap, and then really pushed higher on Friday, back through the balanced price range. So we've gone down, up, down, up, down. This is area being quite efficiently balanced. Price came up into this volume imbalance, and we had the order block. So I was looking at whether we could potentially get above this high and dig deeper into the mean threshold of this order block, maybe get back above this 100 big figure level. We have traded through it once, but we didn't spend a lot of time up there, and we still have this volume imbalance left open above these highs. So we got buy side liquidity above this order block and the closure of the volume imbalance. Whether we get up there, this is what we have today. We're currently trading around that mean threshold level. So we'll see if we close back above that, then the buy side liquidity above this is likely. So if we're expecting higher targets, this might be a decent short-term draw we've gone back above that 100 level, so that may act as resistance if we do trade down into it again. We have that old high there, and these up close candles will become an accumulation block on the right hand side. So a few things that could send us higher, but it's also likely that with the elections we have some really volatile price action, and this might just come up to sweep all the buy side liquidity, rebalance, and then continue lower. We have this trend line forming down here, so there's a lot of sell side liquidity resting below this, and we still have the monthly fair value gap still left open. So it makes more sense with the way things are going on, and interest rate hikes and stuff are still expected. Once the elections are out of the way, we'll see what sort of direction the market really wants to continue in. S&P 500. So we ran higher and dug into this volume imbalance, found some resistance up there, cleared buy side liquidity, and then ran lower, closing below this down close candle, touching the premium end of this volume imbalance. We rallied from there and closed above the daily fair value gap, the premium end. So we may want to find a little bit of support, and then coming into Monday, Tuesday, I haven't actually looked at the chart for the S&P today, so it's likely we'll clear in maybe some of this fair value gap, go above it. We're inside of this daily order block as we are, and then from the wick to the body, we're inside of this breaker, so we've got that high, low, higher high to run the stops, and then broke below it. So we may want to spend a little bit of time in here, even come back to touch the discount end of this fair value gap and then go lower. This becomes a balanced price range for me, really. So unless things change and the top is in place with the dollar and we do keep going lower, then this may want to go higher and take out the relative equal highs above here. I mean, we've already had this stop run to clear sell side liquidity below this low, and then we've had a break in market structure. We've come down and found support back onto a balanced price range, and we're also inside from this low high, lower low, inside of this up close candle, so we're in that bullish breaker. We have had a break in market structure here, so if we don't find any levels up here that's going to offer us any resistance, and we are likely to clear buy side above here, we do have this fair value gap as well. So it'll be interesting to see if we do get higher, do we close above this fair value gap, and if so, could that offer us support and still continue to go higher? From this low to this high, we have found support at that 50% level, so this could likely even consolidate around here and allow the forex market to move. So we may see volatility coming in into forex, but as it stands, I'm still keeping an eye on a relationship between the different asset classes at the minute. It's worth noting that we have quite a long-term SMT divergence between the averages. So on the S&P, as you can see, we failed to take that high yet, and then broke market structure. On the Dow, we have taken that equivalent high, so we've ran that buy side. And on Nasdaq was really weak compared to the other three. We haven't taken that high, and on more of a short-term daily time frame still, we haven't seen the higher high posted in the NAS 100. Which we have seen in the Dow and in the S&P. So that could be potential smart money distribution with a structure break. But like I said, until we get a really clear direction at the minute, like this is it's really difficult to put your finger on it, because we've had a market structure break in both directions and we're currently sitting around that 50% level. So is it high probability trading? On the smaller time frames, you can probably find some setups, but that's probably what I would be leaving it to right now, is in and out and short, quick scalps. On the bonds, so this is the actual bond price. Again, we have more of a long-term SMT. The 30 years failed to make that higher high, whereas the 5-year and the 10-year, we have posted that higher high. So if we do continue with sell-side delivery, then the sell-side liquidity resting below this low is where we're targeting. And if that's the case, this is going to put upward pressure on the dollar index, because if we do continue lower in the bonds, it's going to send the yields higher, and therefore the dollar index should carry on higher. Unless, of course, everything starts moving out of sync. And personally, I wouldn't be surprised just by the way the markets have been moving and behaving over the last month or two. There's a lot of things that are out of sync that we're noticing across the board. When you have that, and again, this is something ICT has taught us, is that when you've got correlated asset classes that are moving out of sync, that is a period of time when you're going to get low probability trading. So, which is why I do tend to keep an eye on different classes to see what's going on. It gives me more of a general overview. When you've got things that are moving in sync, and they eventually will start getting back in sync, that's when you get your salad days, as ICT calls it, where you got your nice, easy trading. Unfortunately, I don't see that on the horizon anytime soon. So I keep saying this and trying to reassure people because I get so many messages of people really struggling right now. It's not easy. Like I really, really cut back in the number of trades that I've been taking. I'm only really trying to take really high probability setups. So you're not alone. People who've been doing this for years, and I speak to people still more experienced than me, and I get advice with them, and they tell me the same thing, that for all the years they've been trading, they've not seen the markets move the way they've been moving. It's a very difficult time to learn, but as the old saying goes, the strongest are made in the hardest times. I think I've heard that somewhere anyway. We also have more of a short-term divergence between the bonds, so we failed to post a higher high in the 10-year and in the 5-year, and we posted that higher high in the 30-year. So again, does this show underlying weakness in the bonds? And if so, we should theoretically be going lower. Like I said, this is all going to be a good study for all of us, myself included, to see how these markets pan out. While I'm on the topic, I mean, I don't like to go into the tinfoil hat talks and stuff, but if you're in the UK, especially, like, they are talking about blackouts, and energy shortages, food shortages. It's all on the horizon. I know ICT goes a bit crazy. I mean, we know ICT loves his tinfoil talks and stuff, and he loves to have a rant. But if you listen to what he actually says, the guy has a point. And a lot of the things that he says, even though they're really long-winded, he's been in this market a long time. And we have to respect the fact that this guy has a lot of experience. And not all of his conspiracies I agree with, but with the way the markets are moving and the current state of the world, the current state of the economy, I do believe we're headed to a whole new monetary policy. I think there's going to be a huge shake-up coming at some point. And whether you believe what ICT says or not, I think it's sensible for us to at least take it on board and maybe prepare just in case. I think that was probably a sensible thing, and I don't want to scare anybody, but there's no harm in being on the safe side at the end of the day. That's the way I'm looking at it. I've stocked up on things myself personally, and taken provisions just in case that we do get, the heating goes off. A lot of the talks of these blackouts are going to be happening in the coldest time of the year, and I mean, we don't have the greatest weather as it is in the UK, and in the winter it does get really cold. So I've personally bought like wood burners and logs and dry wood and stuff like that, just in case I need it. I'm hoping I don't, but if you're looking at what's going on with the news, they're already talking about it. And normally when that happens, whether it's fear-mongering, whether it's true or not, I think what we've seen from COVID, and I know everybody has their opinions on that, and I've got my own, but I won't go into the details. What we did see factually is how people reacted at a time of crisis. Now, people were punching each other over toilet paper. Like, it seemed at the time that civilization was collapsing. And based on what we saw previously and how COVID, I believe, was like the test of what's to come, before shit hits the fan, and being in this group, being in this mentorship, and being able to listen to what ICT says, we're in a little bit of a more unique position to have to predict what may come. Like I said, the markets aren't moving right, and there may be a black swan event on the horizon. And if there is, there's probably nothing we can do about it apart from getting our houses in order, really, stock up on long-term supplies. I'm not saying you need to go crazy with it. Every time you're out or you're going to the grocery store or shopping, just pick up a little bit extra. And things that you might need: candles, torches, batteries, stuff for heating. I picked up a couple of generators recently just in case, just to charge your laptops and phones and whatnot. I'm hoping internet and stuff doesn't go down, because it's going to obviously make it difficult for me to do this. So I've prepared myself with generators just in case I do have that event where the electricity does go. I'm hoping it doesn't happen, because we are heading into scary times. I'm not going to lie. I'm not personally scared about myself. What's going to happen is going to happen. But I think when you've got a family, you've got children to worry about, I think that's when, me personally as a father, that's the scary part. If we end up, going into a war, or we have no food, we have no electricity, it's difficult being in a position where you have younger children and you need to consider them above yourself, really. And in that situation, it's a lot more difficult. I mean, look, it's not going to hurt us just to stock up a little bit extra. And if we don't need it, we don't need it. At least we've got peace of mind. And if we do need it, we're going to at least be like, you know what, ICT was saying this for a long time. We had a lot of time to prepare ourselves. And now we're in a situation where we need the stuff and we can't get hold of it. Because if things really get out of hand, you've seen what it was like when COVID hit. You couldn't get anything from the shelves. They were empty. I guess as a mentor here, I'm just trying to look out for you guys as well, you know, so please don't take this like I'm not a conspiracy theorist really. I'm just trying to think logical and based on what I've seen myself. And don't forget, I was in the middle of COVID working as a pharmacist, so I seen it on the front line really. I think it's more important than ever for us all to take care of one another, you know. So my biggest worry is desperate times make desperate people, and people will go to like some extreme lengths to feed the children, for example, you know. So God forbid things get out of hand. I just wanted to put my 2 cents in there, really. I've had a few questions what my thoughts were on it and stuff, and like I said, I try not to get too political and I try not to get too conspiracy theory stuff. But you've got to really sometimes take a look around and think, right, is there validity to the things that people are saying? And I think with where we are and at this point in time, things may get hairy. And we're going to regret it if we don't do our best to prepare ourselves whilst we can. So that's all I'm going to say on the matter. Anyway, I've digressed. I was taught by ICT, wasn't I? Right, E-mini SMP. So this is last week's price action. So we obviously had non-farm payroll last week, and I didn't trade last week. To be honest, the family was ill, so I was playing mom and dad, and then got ill myself towards the end of the week. So I guess it was a good thing it was non-farm payroll week, because I really do scale back a lot and do very few trading the first week of every month anyway. But let's go over price action and see what transpired, and I'll give a few teaching points today. So Monday, the red lines, the beginning of the week, end of the week, then Monday, Tuesday, Wednesday, Thursday, Friday. I want to do a little bit of teaching about dealing ranges, right? Now the markets move in ranges, and there's a lot of different caveats and stuff that as we get deeper into the mentorship, I'm hoping to delve into a little bit more. But the essentials to a normal dealing range is, realistically, the markets move with a program which we have spoken about in the academy, and this ICT's concept is accumulation, manipulation, and distribution. If I could say the one thing how the algorithm really operates, its main go-to program is accumulation, manipulation, and distribution. In that AMD cycle is where we develop the dealing range, right? So ICT has taught us that the dealing range occurs when we take out a swing low, a swing high, and then the expansion is the dealing range. So on Friday, we had this swing low. We took the sell side liquidity here after we opened up on Friday, and then we ran the buy side liquidity here. And then we had this expansion, right, all the way into the daily volume imbalance on Friday. So the dealing range created was from this low to this high. On Monday, we retraced, consolidated, which is typical for Monday. And then we had the algorithm go into this spooling cycle on Tuesday. Now this spooling cycle is done to engineer sell side liquidity below the market. And it just goes higher and higher and higher and higher until it takes out Friday's high. That now is an algorithmic signal where IPTA has cleared buy side liquidity. So we've taken a daily high, right? And then we have aggressively, when news has come out, ran the sell side liquidity and broke market structure below Monday's low. So this is a key low created on Monday, and this is a key high created on Friday, right? How did we break through that? We left displacement, right? So this is after we've filled in a daily PD array, right? After we ran the sell side and broke market structure, we went back into another spooling cycle of consolidation. And what is consolidation? IPTA is engineering liquidity above and below the market, right? So on Wednesday, we had these relative equal highs, and we ran sell side first, right? That's important. We ran with displacement, and we left the buy side liquidity and the fair value gap, and then found support at the premium end of the daily fair value gap. The news came out, and this is all manual intervention, right? This is why we don't trade high impact news drivers, because you're going to get this, and that's basically a stop run. It's a run on the buy side liquidity and back into a daily higher time frame PD array. We also had these last up close candles. So this is one bearish order block, which is the high probability order block. This one. Why is that? Because it's inside of a higher time frame PD array, right? So ICT teaches the low to the mean threshold is the most sensitive area of an order block. All of this above here is running stops, right? We ran stops above that. And then we had a change in state of delivery and broke, leaving displacement. The order block starts with this candle, and this candle is also inside of that daily premium array. So this is going to be a high probability order block in these series of up close candles. It's not always going to be just the up close candle before the down move, even though we've seen this displacement. And this looks like, yeah, this might be the high probability order block. But then you have to look at the hierarchy of the time frames. This is a daily PD array. This is a 1 hour up close candle, right? We also have this last down close candle in here as well, which is our distribution block. We hit into that nicely. And we have from this candle's low to this candle's high, we have this hourly fair value gap, which is also nested inside of the daily volume imbalance. So they ran price higher, clearing out the buy side liquidity above these equal highs and into that higher time frame premium array. And then as you can see, price really rolled over, attacking the sell side liquidity below this low, and it traveled right through the fair value gap. We then had a little bit of a bounce higher, came into the daily fair value gap, back into this high, low, high, high. So we have a breaker, and we also have the consequent encroachment of this daily fair value gap. So we found resistance there. Price rolled over and into the opposite end of the daily volume imbalance. So we had a daily volume imbalance up here and a daily volume imbalance down here. Interestingly, we open right in the middle of these two volume imbalances. And if you extend that weekly open out in time, we nail it perfectly on Friday. If we take this low to this high, not this high, this high. Why? Because as we broke structure here to the upside, this becomes a new higher high, right? So we have to extend the dealing range. So initially the dealing range was from this low to this high. Then when this high got violated, the new high becomes the high of the dealing range, right? If we run a fib from this low to this high and we get that 50% level, number one, you should notice around that 50% level is where we're likely to see fair value gaps form. If we extend that out in time, the 50% level, look at the bodies respecting that level there, right? So this was all manual intervention, but the bulk of the volume still respected the 50%. Also notice that at that 50% level, we also had another displacement and fair value gap, and the consequent encroachment area lies perfectly in that 50% level. This is algorithmic market structure essentially, right? Now, how did we break the dealing range low? We left displacement, right? Again, that's an algorithmic signature. Where did the dealing range start? So price all over here was inside of the dealing range from this low to this high. Well, this is where the initial dealing range started. So this is your initial consolidation, right? So we had our accumulation, then we had our manipulation, then we had our distribution. So we ran the lows, we ran the sell side, the buy side, and created our initial dealing range, right? So our initial dealing range for Monday, Tuesday, Wednesday was created on the Friday. Now if we take the high and the low and we project our fib standard deviations, 1, 2, 3 standard deviations almost gives us the high, and 1, 2 standard deviations down we get 3704.5. I've left the cursor hovering above this candle, and we come in at 3704.25, so 0.25 off. So again, IPDA is going to look at these dealing ranges, and where the initial consolidation is with these dealing ranges is where it will project standard deviations. It's based on mathematical formulas, really. So the whole structure is based on mathematical formulas. To go into a little bit more detail, we broke this low, so the dealing range low, we broke that with, again, displacement, so again, algorithmic. And then we came lower and made the low on Thursday, right? So the high was made on Tuesday, and the opposite end was made on Thursday. So the new dealing range, after we broke the dealing range low, is going to be from this candle's high and this candle's low. Why this high and this low? What did we have here? Well, this is our accumulation phase, right? This is accumulation, manipulation, ran the buy stops, and then distribution, and we ran the sell stops. So initially the dealing range was from this high to this low, and then we extend it because we broke the low, but we have the high still intact. So until this high gets violated, or we see a smaller short-term dealing range, which you can always get dealing ranges inside of dealing ranges, you want to keep on a higher time frame dealing range structure. So we're here on the hourly time frame. Of course, you're going to get smaller micro dealing ranges when you go to a lower time frame. But again, just like how we're using the higher time frame PD arrays and the higher time frame narrative, that's the same way you want to look at it when it comes to higher time frame dealing ranges. Once we broke below this low and we extended the dealing range from this high to this low, 50% of that dealing range also sits inside of this fair value gap. And on Friday, we came back and nailed the 50% level again from that dealing range, which also overlaps with the weekly open, which started that initial cycle. So when you start blending dealing ranges, premium discount arrays, market structure, time of day, liquidity pools, consolidation areas, high impact news events, it's impossible to think that, like, knowing what we know and how we can now see price and how price reacts to levels where we anticipate now, it's very, very, very difficult to say that there isn't an algorithm that runs these markets. And when you dissect everything down, you have to understand that if everything is based on time and price, and the algorithm is very limited in what it can do, there has to be certain macro points that the algorithm has to refer to. Whether it's macro points in time and macro points in price, the low, the midpoint, and the high all have significant implications when it comes to them being respected or broken. And that is another way how we can understand bias and narrative. Of course, we have to put order flow behind that. And I think when many people come into learning ICT concepts, you see, oh, there's an order block, there's a fair value gap, and it looks like it's easy. Now, some of you have been here a while, and you can see that it's not as easy and straightforward as it looks. This goes a whole lot deeper, and it goes deeper still. I'm still only really scratching the surface of things here, but I call this algorithmic market structure. And the reason for that is because algorithmic market structure is based on macro price points, is based on macro price points that the algorithm should retain in its logic. And in between these price points, it will engineer liquidity in the form of spooling cycles and consolidations. Anyways, I've waffled on this one. I'm drugged up with medicine, so allow me. So I hope you guys found this one insightful, and I'll catch you guys again next week.